The next rule for minimizing the currency risk is that currency option. It defines that it gives the holder the right, but without any requirement, to buy or sell a currency at a specified price on a particular date, which is known as strike price. Let's move on the benefits of the currency option. First one is protection with stability. This option provides protection against the negative movements in the currency market. So, in that way, the holder can independently see what are all the favorable movements in the currency market. Next benefit is the limited risk. The maximum amount of loss is limited to the premium paid by the holder. On the other hand, the currency option have limitations like time decay and cost. First one is time decay. If this option reaches its expiration date, it leading to a loss if not managed properly. Next limitation is that cost. The premium paid for this option can be significant, especially in the volatile market.
Leading means making payments in advance, that is before the due date, and lagging means making payment after the due date, and its benefits are reduces currency risk, optimizes cash flow, and take advantages of the market conditions, and its limitations are complexity in execution and timing risk.
So coming to currency swap means it is a financial agreement between two parties to exchange principal and interest payments in different currencies for a specific period. And coming to benefits of currency swap, first one is hedging against currency risk. Hedging against currency risk means it helps companies to protect against fluctuations in exchange rates, reducing currency risk exposure, etc. And next one is diversification. Diversification, it allows companies to diversify their debit portfolio by borrowing in different currencies. And limitations of currency swaps, first one is counterparty risk. Counterparty risk means the risk that one party may default on their obligations, leading to potential losses. And next one is complexity. Complexity means currency swap can be complex to structure and manage, and requiring expertise in currency exchange market.
So I'll be talking about money market hedging and netting. So first of all, what is money market hedging? It is a technique where a company uses short-term loans and advances to protect itself from fluctuations in exchange rates for future foreign currency payments or receipts. So some of its benefits are locks in exchange rates. It provides certainty about future cash flows by locking in exchange rates. Then it is flexible. It can be used for both payables and receivables accounts, and it is simple to implement, relatively straightforward to use, and easy to set up. Limitations are opportunity cost. What do I say? It ties up funds that could be used elsewhere, potentially leading to missed opportunities. Then limited short term. It means it is best suited for short term hedging and may not be effective for long term obligations. Next, I'll talk about netting. Netting is a process where multiple financial obligations between two or more parties are combined into one single payment, reducing the total number of transactions. And benefits are reduces risk, lowers the exposure between parties by offsetting obligations, and then simple transactions, decreases the number of payments, making financial processes more efficient. Then limitations, it requires agreement. All parties must agree to the netting agreement, which may not be always possible. And then limited to multiple transactions, it is more effective when there are many transactions between parties.
I'll be explaining about diversification. Diversification is a strategy of spreading investments across different assets or sectors to reduce overall risk. The benefits of diversification are as follows. The first benefit is it reduces risk. It limits the impact of poor performance in any single investment, lowering overall risk. The next benefit of diversification is it improves stability. It help smooth out returns by balancing high and low performing investments. The next benefit of diversification is and it enhances the chances of benefiting from growth in various sectors or markets. The limitations associated with diversification are potential lower returns. Diversification can lead to more average performance, which might mean missing out on high returns from single strong performer. The next limitation of diversification is too much diversification may dilute the potential benefits of any single investment. That's it.
We were going to be talking about forward contracts and derivatives. Currently, forward contracts, it's one of the most simplest hedging mechanisms out there now. Talking about hedging is kind of any kind of activity to be take in order to mitigate risks associated with any kind of activities. Forward contracts, well, basically, for an example, let's say that I am a manufacturer of gold jewelry, and I am worried about the prices of gold being affected due to various reasons. And let's say Mr. X is a gold supplier. I enter into a contract with Mr. X stating that in a future date, in a particular future date, I would buy a certain amount of gold for a fixed price. This is a prime example of what a forward contract will look like. Well, benefit of some forward contracts is, well, basically hedging against future fluctuations, and it's also customizable. Now coming to derivatives, derivatives are financial instruments whose value relies on an underlying asset like stocks, bonds, etc. Well, how the way which an institution or a person can use derivatives to hedge is, for example, let's take a look at the case of options. We do have put options and call options, and for your understanding, when the premium paid for put option goes up when the price of the underlying asset goes down, and the premium paid for the call option goes up when the value of the underlying asset also goes up. So call option premium and the underlying assets value are in, what do you say, they're directly proportional to each other, whereas the put options premium and the underlying assets value are inversely proportional. So let's say I hold a certain amount of gold at hand, and I am worried about, like I said before, I'm worried about the fluctuations of gold, and according to my calculations, the gold price may drop down due to economic conditions and such. So I may enter into a put option that way. So the loss I inherit can be set off with the profit I made from the options.